Saving and investing for students. Granted, money doesn't grow on trees, but it can grow when you save and invest wisely. Knowing how to secure your financial well being is one of the most important things you'll ever need in life. You don't have to be a genius to do it. And remember, no one is born knowing how to save or invest. Every successful investor begins with the basics, the information in this video. A few people may stumble upon financial security. A lottery ticket number turns out lucky, a business takes off, or a wealthy family member dies. But for most people, financial security comes over a long period of discipline, perseverance, and patience in saving and investing. As a student, you might be thinking that saving and investing is something you don't need to do right now. But there is a cost to waiting. And even saving a little now can add up over time and help you pay for your short and long-term goals. Watch the video now and start saving and investing today. Welcome back, folks, to another edition of Sweetie Kiwi. How you doing today? I hope you are doing fantastic. I'm doing marvelous if you're to ask me. And if you are doing as marvelous as I am, go grab a cup of coffee or tea or vodka and let's roll. I want to talk to you today about saving and investing for students. Now, this show is for everyone, whether you are students, whether you are in your teens, in your late teens, your early 20s, or you are in your 30s and 40s, doesn't really matter because the advice here is applicable across the board. Step one, make a financial plan. You want to know the things you want to save and invest for. Do you want a car, an education, a comfortable social life, emergencies, periods of employment, your future goals? Mark those things down. You want to make your own list and then think about which goals are the most important to you. List your most important goals first. So you want to go from the most important to the least important. Decide how many years you have to meet each specific goal. Because when you save or invest, you will need to find a savings or investment option that fits your time frame for meeting each goal. Many tools exist on the internet to help you put your financial plan together. So I'm putting on the screen right now a list of a little checklist of your financial goals. And we are looking at the timing that is applicable to those financial goals. So if you don't know where you're going, you may end up somewhere you don't want to be. So to end up where you want to be, you'll need a roadmap, a financial plan. You need a financial GPS. So in the first column, you want to put down what you want to save or invest for. And in the second column, you want to write down by when. Let me give you an example. Let's say you want to save for a car and you want to buy a car that will cost you $20,000. Let's just be a little optimistic here, $20,000. And you know that you want to have the car in 5 years. So you'll put what do you want to save or invest for. Number one, you put car. And by when? 5 years from now. So if you are in 2020, that will be 2025 and so on and so forth. That means that you need to save every year $4,000. And that means that you need to have a job that pays you well enough for you to take care of your living expenses and have some cash to save for this car. Here, the goal is not to just save. You can also think about investing. If you are lucky enough, 5 years is kind of small when it comes to investment to be able, unless you're really lucky, you have an IPO, you have an initial public offering, a stock that flies, that really makes 200 or 300% return on investment, but those are very rare. Let's be optimistic here. So if you need to have 20 grand in 5 years, you need to save 4 grand every year, or you need to invest a certain amount that helps you get 20 grand in 5 years. Either way, you need to figure out that. But I will talk about that, how to figure out those choices in the rest of the show. So just remember, for now, you need to know the things you want to save for or you want to invest for. And that you need to make a financial plan. Once you make a financial plan, you need to know your current financial situation. So you want to sit down and take an honest look at your entire financial situation. You can never take a journey without knowing where you're starting from, and a journey to financial comfort is not different from any other journey. So you need to figure out on paper your current financial situation, what you own and what you owe. So you'll be creating something called a net worth statement. Sometimes it's also called a personal balance sheet. So a balance sheet, and you're looking at it here. I have on the screen right now another little table that is called net worth statement, and on each side of the page you have specific elements. So on one side to the left you have something called assets. Your assets are what you own, what belongs to you, and on the other side you have what you owe, your liabilities or debts. So that's called your net worth statements. Your net worth statements equal your assets minus your liabilities. So assets, as you can see here, assets, you have cash, checking accounts, savings, other investments, and personal property. And then you put the current value of those assets. Cash, of course, it's the current value, checking accounts, savings. Now, the reason why you have the current value is because some assets are not valued immediately. For example, if you own real estate, if you have personal property or real property, the value may not be easily determinable unless you sell the property or you ask an appraiser to evaluate the property. So it's really important to have the current value. So you have the total of the current value of the assets, and you do the same thing for liabilities. So liabilities, you have credit cards, bank loans, car loans, student loans, and other. So to get your net worth, you need to subtract your liabilities from your assets. So if your assets are larger than your liabilities, you have a positive net worth. And if your liabilities are greater than your assets, you have a negative net worth. So you want to update your net worth statement every year to keep track of how you are doing financially speaking. Don't be discouraged, my friend. If you're having a negative net worth every now and then, it's okay. As long as you have a plan to get into a positive position, you are doing the right thing. You are on the right track. Know your income and expenses. The next step is to keep track of your income and your expenses for every month. You want to write down what you earn and then your monthly expenses. Why? Because your income and expenses ultimately will affect your assets and liabilities. Your expenses, what you buy, if you use your credit card, if you use your own money or you borrow to pay for those expenses, your expenses will ultimately affect your liabilities. Okay, remember though, as I said earlier, that your net worth statement is the same thing as your net worth statement is the same thing as balance sheet. Sometimes experts call it statement of financial position or statement of financial condition. As we continue to talk about saving and investing for students, I want you to remember these things. Always pay yourself first. You want to include a category for savings and investing. What are you paying yourself every month? Many people get into the habit of saving and investing by following this advice. Always pay yourself first. You will find it easier to pay yourself if you allow your bank to automatically remove money from your paycheck and deposit it into a savings or retirement account or even investment account. If you work, you may be eligible to participate in an employer-sponsored retirement plan such as a 401k, a 403b, that's for people who work in the public sector, or a 457b. That automatically deducts money from your paycheck and may reduce the taxes you're paying. Additionally, in many plans, the employer matches some or all of your contribution. So when your employer does that, it's offering free money. Think about it. Let's say you just stash away $5,000 a year, and your employer is matching that amount. That's $10,000 go into your account. That's free money. Anytime you have automatic deductions made from your paycheck or bank account, you will increase the chances of being able to stick to your plan and realize your goals. The idea here is to automate things, to forget about it. Just forget about it. Set it up once and just forget about it, right? Because if you have to do this manually, if you have to every month go into your account and just withdraw the money or just do the transfer manually. Some months you might be lazy. Stuff happens. Stuff happens. You're lazy, or there are a lot of stuff. You're tempted to spend the money on the new Nike or the Nike shoes or the new dress that you saw at the store. So you're conflicted. But if you just set things up automatically, then you don't have to think anymore. The system takes care of it. The banks and your employer's 401k program takes care of it automatically, and that's what you want. So you want to find money to save or invest. How do you find money to save and invest? If you're spending all your income and never have money to save or invest, you will need to look for ways to cut back on your expenses. Are you living beyond your means? Are you buying stuff that you don't really need? Is it time to clutter? Is it time to become a minimalist, to enjoy life but more smartly, more intelligently? Those are questions you have to think about, my friend, here. And when you watch where you spend your money, you'll be surprised how small everyday expenses that you can do without add up over a year. And I have here another little table where I'm just saying, know your income or what you spend. So your monthly income on top, we're putting the table on the screen right now so you can see that monthly income, and then you have monthly expenses. Remember that I put in the first two lines before anything else, I have savings and investments. Those are expenses. As I said earlier, you need to pay yourself first. You got to pay yourself, and those payments that you're sending to yourself are in the form of savings and investments. And after that, you have rent or mortgage, telephone, utilities, clothing, food, transportation, loans, insurance, education, music, recreation, gifts, other. And then you just sum everything up and it tells you the total. As I said just a few minutes ago, you want to look for ways to cut, if possible, on certain items in this budget here, so you're able to have more money going to in the first top two expenses, i.e. savings and investments. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic. We're also having here a conversation around savings and investing for students. And as I said earlier, this conversation is not only applicable to students, it goes beyond that. The target audience is way beyond students. So if you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so you are informed in real time whenever we release a new show. And like this content, share, and most importantly, comment below. If you have questions, comment below. We answer every question that is relevant to the topic. Our team takes pride in reading and commenting and answering any question that is left on our page. I want you to remember that small savings add up to big money. When it comes to savings, when it comes to investing, you have two types of magic. You have the magic of compounding, and you have the magic of little savings. I'm going to talk to you now about little savings. The compounding part of things I will address it later on today in the show. But how much does a bottle of soda cost you? Well, think about it. I'm just using a basic example. If you buy a bottle of soda every day for $2, that adds up to $730 a year. Think about that. $2 times 365, that is $730 a year. So $2 may seem like nothing to you on a daily basis, but on a yearly basis, that's $730. That's a lot. So if you saved that $730 for just 1 year and put into a savings account or investment that earns, say, 5% a year, that would grow to $931 after 5 years and grow to $3,155.02 after 30 years. That's the power of compounding. That's the power of savings, but also the power of compounding. With compound interest, you earn interest on the money you save, and on the interest that money earns. Over time, even a small amount saved can add up to big money. Here, I'm talking. I've only I've only taken $2 and I've only taken a small example, but I'm sure if you look into your budget, there are other little areas where you can just reduce, you can spend less, and that means more money into your pocket. Over time, even a small amount saved can add up to big money. If you're willing to watch what you spend and look for little ways to save on a regular schedule, you can make money grow. It's all about discipline, persistence, perseverance, and most important, consistency. You just did that. You just imagine what you achieved with one bottle of soda, more than 3,000 after 30 years. If a bottle of soda can make such a huge difference, start looking at how you can make your money grow if you decided to spend less on other things and save those extra dollars. If you buy on impulse, make a rule that you always wait 24 hours to buy anything. You might lose your desire to buy it after a day, and try emptying your pocket and wallet of spare change at the end of each day and put that money aside. Again, you will be surprised of how quickly those nickels and dimes add up. They might seem small, but add them up over time, you'll be surprised. Let's now talk about credit card and liabilities. You want to pay off credit cards or other high interest debt. Speaking of things adding up, few investment strategies pay up as well as or with less risk than merely paying off all high interest debt you may have. Many people have credit cards. Some people even have 3, 4, 5 credit cards, some of which they have maxed out, meaning they've spent up to the limit, to the credit limits. Credit cards can make it seem easy to buy expensive things when you don't have the cash in your pocket or in the bank. But credit cards are not free money. Most credit cards charge high interest rates, as much as 18, 20, 25% if you don't pay off your balance in full each month. If you owe money on your credit cards, the wisest thing you can do is pay off the balance in full as quickly as possible. Remember that virtually no investment will give you the high returns you will need to keep pace with an 18% interest charge. That's why you're better off eliminating all credit card debt before investing in and having savings. Once you paid off your credit cards, you can budget your money and begin to save and invest. Here are some tips for avoiding credit card debts in the first place. Please, just put away the plastic. Don't use a credit card unless your debt is at a manageable level and you know you'll have the money to pay the bill when it arrives. For instance, you have a better job, you have a stable job, and you're comfortable that based on your income, you can take care of the credit card debt every month. And every month, not every year. Don't just pay the minimum payment and leave the bulk of the debt accrue from month to month. No. The second thing you want to know if you cannot put away the plastic, please know what you owe. It's easy to forget how much you've charged on your credit card, but every time you use a credit card, write down how much you have spent and figure out how much you'll have to pay that month. Keep track of your accounts online. If you know you won't be able to pay your balance in full, try to figure out how much you can pay each month and how long it will take you to pay the balance in full. This is not complicated, folks. What I'm telling you here is a little bit of perseverance, a little bit of discipline, a little bit of work on a daily basis, but that pays off humongously over time. Also, you want to pay off the card with the highest interest rate. If you've got unpaid balances on several credit cards, you should pay down the card that charges the highest rate first. Pay as much as you can toward that debt each month until your balance is once again zero, while still paying the minimum on your other credit cards. Now, once you have paid off those credit cards and begun to set aside some money to save and invest, what are your choices? Let's talk about the choices when it comes to investing. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Q. We're also having a conversation now around saving and investing. And today's conversation is geared towards students, but also non-students. Learn how to make money grow, how to make your money grow. Know the two ways to make money. There are basically two ways to make money. You work for money, and your money works for you. There are only two ways, no question about it. You work for money means someone pays you to work for them, and you have your own business. you have a 9 to 5 or you have a 9 to 9, depending upon how long you work. But the thing is, you're working for money. And the thing here is that if you don't work, you don't earn. You have to work to earn money. That's the paradigm. That's the approach that you have in the first category. The second category is your money works for you. So you take your money and you save or invest it. So your money can work for you in two ways. Your money earns money. So when your money goes to work, it may earn a steady paycheck. Someone pays you to use your money for a period of time. So when you get your money back, you'll get it back plus interest. So your money pays you, your money works for you. You have lent, you have loaned your money to someone. You have bought something called bonds, corporate bonds on the market, and the company, the bond issuer, is paying you interest every quarter, every year. And at the end of the loan period, called maturity, you get the principal amount back, your money back. That's one way of having your money, earning money for you. The second way is you buy stock in a company that pays something called dividends to shareholders. The company may pay you a portion of its earnings on a regular basis. Your money can make an income just like you. You can make more money when you and your money work. You buy something with your money that could increase in value. You become an owner of something that you hope increases in value over time. So when you need your money back, you sell it, hoping someone else will pay you more for it. For instance, you collect comic books thinking they will increase in value over time. You expect to sell them in, say, 5, 10, or even 20 years when someone will buy them from you for a lot of money than you paid for it. And sometimes your money can do both at the same time. So earn a steady paycheck and increase in value. This is the possibility you have with the stock. So when you buy a share in a company, let's say Tesla or Amazon, if Tesla or Amazon issues or pays dividends on a quarterly basis or biannual or annual basis, that's the steady paycheck I was talking about. But the value of the stock, the value of the share can also increase. So when that happens, you have an appreciation in the stock's price. So you're actually earning two ways. Earning two ways is pretty good, but there are differences between saving and investing. Let's first talk about saving. Your savings are usually put into the safest place or products that allow you to access your money at any time. So savings products include savings accounts, checking accounts, and certificate of deposits. Some deposits in these products may be insured by the FDIC, the Federal Deposit Insurance Corporation, or if you have your money in a credit union, you have the National Credit Union Administration. If the FDIC insures you the deposit, it does so up to $250,000. It's $250,000. So when you have your money saved in one of those safest products, if you will, savings accounts, checking accounts, or certificate of deposits, there is a trade-off you have to be aware of. There is a trade-off for security and ready availability. Your money is paid a low wage as it works for you. You have to pay enough credit cards or other high interest debts. Most smart investors put enough money in a savings product to cover an emergency like sudden unemployment. So make sure they have up to 6 months of your income in savings so that if something happens to you, you know you have enough cash to ride the hard times. I personally suggest having 1 year because 6 months is not really enough. 6 months is pretty cool when you think about it in theory, but stuff happens. If you lose your job and you have other emergencies around, 6 months is really not a lot. Especially if we are in an economy, let's say we are in a recession where it becomes harder to get a job, then 6 months is pretty low. So you want to go to 1 year or 18 months. So how safe is a savings account if you leave all your money there for a long time and the interest it earns does not keep up with inflation? What if you save $1 when it can buy a loaf of bread? But years later on, when you withdraw that dollar plus the interest you earn on it, you can only buy half a loaf. That's what economists and other financial experts called inflation risk. The risk that the money you have saved over years is not enough to keep up with inflation. Inflation means that prices are going up every year. Things increase, and that's just normal. This is why many people put some of their money in savings but look to investing so they can earn more over long periods of time, say 3, 5, or 7 years. And that's what we now talking about investing. So when you invest, you have a greater chance of losing your money than when you save. The money you invest in securities, stocks, ETFs, mutual funds, and other similar investment typically is not federally insured, so the FDIC is not insuring anything, nor is the SEC, the Securities and Exchange Commission. So you could lose, in theory, your principal, in other words, the amount you've invested, but you also have the opportunity to earn more money. So let's kind of look at the basic types of products here. As you can see on the screen, we have savings and investments. When it comes to savings, we have savings accounts, certificates of deposits, and checking accounts. Those are quote unquote savings accounts. We put here the checking accounts in the category of savings because that money is FDIC insured. It's money that's guaranteed. You're not investing it. It's money that you use to pay your bills. Unless the bank goes under, your money is safe. And then in the investment category, you have bonds, stocks, mutual funds, ETFs. Those are exchange traded funds, real estate, and commodities, gold, silver, platinum, and so on and so forth. Let's talk a little bit now about risks. What about risk? All investments involve taking on risk. It's important that you go into any investment in stock, bonds, or mutual funds with a full understanding that you could lose some of all of your money in one investment. While over the long term, the stock market has historically provided about 10% annual returns, the long term sometimes take a rather long time to play out. Those who have invested all of their money in the stock market at its peak in 1929, before the stock market crash, they would have to wait over 20 years to see the stock market return to the same level. However, those that kept adding money to the market throughout that time would have done very well for themselves, as the lower cost of stock in the 1930s made some hefty gains for those who bought and held over the course of the next 20 years or more. So it is often said that the greater the risk, the greater the potential reward in investing. But taking on unnecessary risk is often avoidable. How do you avoid that? Through something called diversification. You want to make sure you don't put all your eggs in one basket. You want to diversify. So once you've saved money for investing, consider carefully all your options and think about what diversification strategy makes sense for you. So you can invest in stocks, mutual funds, bonds, bond mutual funds, CDs, and U.S. Treasury securities. What are the best investment for you? That's the question a lot of people ask. And if you are students right now, you're asking, what is the best strategy, the best investment strategy for you? What are the best investment products for you? It all depends. It all depends. The answer depends on when you will need the money, your goals, and if you'll be able to sleep at night. If you purchase a risky investment where you could lose your principal, for instance, if you're saving for a long-term goal, such as a college fund for a child, you may want to consider riskier investment products, knowing that if you stick to only the savings products or to less risky investment products, your money will grow too slowly, or given inflation and taxes, you may lose the purchasing power of your money. That's what I said earlier when I was talking to inflation risk. So a frequent mistake that people make is putting money they will not need for a very long time in investment that pay a low amount of interest. On the other hand, if you are saving for a short-term goal, 5 years or less, such as a car, you don't want to choose a risky investment because when it's time to sell, you may have to take a loss. Since investments often move up and down in value rapidly, you want to make sure that you can wait and sell at the best possible time. Let's talk about, when we talk about investments, what are those really about? What are investments all about? When you make an investment, you're giving your money to a company or enterprise, hoping that it will be successful and pay you back with even more money. That's the basic premise here. Let's first talk about stocks and bonds. Many companies offer investors the opportunity to buy either stocks or bonds. Now, let's say you believe that a company that makes computers may be a good investment. Everyone you know is buying one of their computers, and your friends report that the company's laptops rarely break down and run well for years. Wonderful, right? You either have an investment professional investigate the company and read as much as possible about it, or you do it yourself. After your research, you are convinced it is a solid company that will sell many more computers in the years ahead. So the computer company offers both stocks and bonds. With the bonds, the company agrees to pay you back your initial investments in, say, 5, 10, or 20 years, plus pay you interest twice a year at the rate of 5 or 4%. If you buy the stock, you take on the risk of potentially losing a portion or all of your initial investments if the company does poorly or the stock market drops in value. In other words, let's say you buy the stock at $10 a piece, and the company does not fare operationally the way investors expected, so the stock price tanks. So from $10 a piece, the value of the share goes to, say, $2 a piece. So you are technically at a loss at a moment. Now, that loss though, it's on paper. In other words, as long as you wait, as long as you don't sell the shares, you are okay. Because that loss is what economists call unrealized loss. If you buy the stock, that's the risk you have. But you also may see the stock increase in value beyond what you could earn from the bonds. If you buy the stock, you become an owner of the company. So let's say after 5 years, the value of the stock goes to $20 a piece, $20 a piece, or $30 a piece. Again, if you don't sell it, you have an unrealized profit, an unrealized gain. But once you sell it, that's money, that is your money. Of course, after paying capital gains taxes. So that's the possibility that you have there to make money if you buy a share of the company, versus if you bought the bond, whereby you are lending, you are a lender, you are a bondholder, you are lending to the company, and they are paying you, say, 4 or 5% or 10% every year in interest. Think about it as if you're a bondholder, it's kind of similar to if you lend money to a friend or a colleague or a family member, and he or she agrees to pay you interest over time, and then to give you your money back, the principal amount, say after 3 or 5 years. It's the same thing. So the one thing you have to understand when it comes to bonds and stocks is what I have here on the screen for you. The main differences between stocks and bonds. Stocks, if the company profits or is perceived as having strong potential, its stock may go up in value and pay dividends. You may make more money than from the bonds. The risk here is that the company may do poorly and you'll lose a portion or all of your investments. For the bonds, you have something totally different. The company promises to return money plus interest. That's the approach when you are a bondholder. You are getting interest during the period where the bonds are out, and then you get the principal amount, the money you have lent the company at the end. The risk is that if the company goes bankrupt, your money may be lost, but if there is any money left, you'll be paid before stockholders. So you have to take your time and make a careful decision. Only time will tell if you made the right choice. You'll keep a close eye on the company and keep the investment as long as the company keeps selling a quality computer. In our example here, the consumer wants to use, and you want to see how things go from there. Let's talk about why some investments make money and others don't. This is a great question. This is the $1 million question here. I don't have a crystal ball to tell you why, but you can potentially make money in an investment in a company if the company performs better than its competitors. Other investors recognize it's a great company, so that when it comes time to sell your investments, others want to buy it. The company makes profits, meaning they make enough money to pay you interest for your bond or maybe dividends on your stock. That's when you can potentially make money in an investment. You can lose money if consumers don't want to buy the company's products or services. The company's officers mismanage the business. We've seen this a lot. They spend too much money and their expenses are larger than their profits. Other investors that you would need to sell to think the company's stock is too expensive given its performance and the future outlook. The people running the company are ensnared in fraud. So if you have some kind of a government investigation going on, or the SEC, the Securities and Exchange Commission, has opened an investigation into the company's leadership, this could make the stock's price sink. For whatever reason, you have to sell your investment when the market is down. That's when you can lose money. If you remember earlier, I was telling you, as long as you don't sell, as long as you you hold on to the stock or bonds, you're fine. You may have a temporary loss. That's called unrealized loss. But if you don't sell it, you're fine. But if you sell it, that's when you have a real loss. Like this is not a paper loss anymore. This is a real loss. This will bite you into your budget. This will increase your wealth, and so on and so forth. Let's talk about mutual funds and exchange traded funds, the ETFs, because it is sometimes hard for investors to become experts on various businesses. For example, what are the best telecommunications, pharmaceuticals, or computer companies? Investors often depend on professionals who are trained to investigate companies and recommend companies that are likely to succeed. Remember though, it takes work to pick the stocks or bonds of the companies that have the best chance to do well in the future. This is why a lot of investors choose to invest in mutual funds and ETFs. What are mutual funds and ETFs? I'm going to give you a quick definition. A mutual fund or ETF is a pool of money run by a professional or group of professionals called the investment advisor. In a managed fund, if they're investigating the prospects of many companies, the fund's investment advisor will pick the stocks or bonds of companies and put them in a fund. Investors can buy shares of the fund, and their shares rise or fall in value as the values of the stocks and bonds in the fund rise and fall. So there is a direct correlation there. Investors may typically pay a fee when they buy or sell shares in the fund, and those fees in part pay the salaries and expenses of the professionals who manage the fund. Even small fees can and do add up and eat into a significant chunk of the returns a fund is likely to produce. So you need to look carefully at how much a fund costs and think about how much it will cost you over the amount of time you plan to own its shares. So if two funds are similar in every way except that one charges a higher fee than the other, you'll make more money by choosing the fund with the lower annual cost. And this is true because mutual funds and ETFs can come in two forms. You have those that have active managements and those that have inactive managements. So one way that investors can obtain for themselves nearly the full returns of the market is to invest in something called an index fund. This is a fund that does not attempt to pick and choose stocks of individual companies based upon the research of the fund managers. An index fund seeks to equal the returns of a major stock market index, such as the S&P, the Standard & Poor's 500, the Wilshire 5000, or the Russell 3000. Through computer-programmed buying and selling, an index fund typically tracks the holdings of a chosen index and so shows the same return as an index minus, of course, the annual fees involved in running the fund. Because, again, even an index fund, somebody has to pay the computer programmers, they has to pay the admin people, the back office, the front office, the middle office. So they also get their little cut, the annual fees. The fees for index mutual funds and ETFs generally are much lower than the fees for managed funds. And this is because the ETFs and the index funds use more electronic technology, I would say technological expertise, to pick the funds and to run the companies than a traditional mutual fund. Historical data shows that the index funds have, primarily because of their lower fees, enjoyed higher returns than the average managed fund. But like any investment, index funds involve risk. You want to watch turnover to avoid paying excess taxes when it comes to managed funds and ETFs. So to maximize your fund returns, or your any investment returns for that matter, know the effect that taxes can have on what actually ends up in your pocket. I was talking to you earlier about capital gains taxes. Funds that trade quickly in and out of stocks will have what's known as a high turnover. So while selling a stock that has moved up in price does lock in a profit for the fund, this is a profit for which taxes have to be paid. Turnover in a fund creates taxable capital gains, which are paid by the fund shareholders. All funds are now mandated by the Securities and Exchange Commission to show both their before and after tax returns. So the differences between what a fund is reportedly earning and what a fund is earning after taxes are paid on the dividends and capital gains, and this can be quite striking. So one word of advice here: if you plan to hold funds in a taxable account, be sure to check out this historical returns in the fund prospectus to see what kind of taxes you might likely be compelled to pay in the future. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are still enjoying today's conversation. We're having a conversation today around savings and investing for students. And this show, of course, as I've said it before, this content is applicable to anyone, not just to students or people in their 20s or late teens. And I want to talk to you now about how to learn risk mitigation. You need to learn how to protect yourself. And there are several ways to do this. There are several ways to kind of cover your back when it comes to investing. And if you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so you are aware of a new show whenever we drop it. And we drop this kind of shows every single day, rain or shine. Learn how to protect yourself. The best way to do this is first ask questions. Many people hire an investment professionals to assist in selecting investment. That's pretty good. You can never ask a dumb question about your investments and the people who help you choose them, especially when it comes to how much you'll be paying for any investment, both in upfront cost and ongoing management fees. Let me give you a few questions you should ask when choosing an investment professional or someone to help you. Please take note. I'm going to go as slowly as possible. The first question is, what training and experience do you have? How long have you been in business? You want to know the person's experience. You want to know that this is a veteran. This is someone who has experience, not just a rookie. What is your investment philosophy? Do you take a lot of risks, or are you more concerned about the safety of my money? Can be more direct than that. A third question you want to ask an investment professional, a financial advisor, a financial planner who wants to help you. Describe your typical client to me. Can you provide me with references, the names of people who have invested with you for a long time? You're looking here for stability and consistency over time. How do you get paid? By commission? Based on a percentage of assets you manage? Another method? Do you get paid more for selling your own firm's products? Another question you can ask: how much will it cost me in total to do business with you? It is very important to be direct upfront, with the professional who wants to help you, because this is your money. This is not somebody else's money. This is your hard-earned money. You need to have you need to ask questions and get the answers, and you deserve answers. Your investment professional should understand your investment goals, whether you're saving to buy a car or to pay for your education. He or she should also understand your tolerance for risk. Are you risk averse, or are you a risk taker? Tolerance for risk means that how much money can you afford to lose if the value of one of your investments declines. An investment professional has a duty, and that's called the fiduciary duty. They have a duty to make sure that he or she only recommends investments that are suitable for you. That is, that the investment makes sense for you based on your other securities holdings, your financial positions, your means, and any other information that your investment professional thinks is important. The best investment professional is one who fully understands your goals and matches investment recommendations to your objectives. So you want someone who can understand you, and someone you yourself can understand, because your investment professional should teach you about investing and the investment products that fit your goals. Another way to protect yourself, besides asking questions, you also want to monitor your investments. Investing makes it possible for your money to work for you. That I've already explained to you. In a sense, your money has become your employee, right? And that makes you the boss. So you want to keep a close watch on how your employee, aka your money, is doing. Some people like to look at the stock quotations every day to see how their investments have done. I don't think that's the right way to do things. You just get all the headache for nothing. It's too often. You may get too caught. You can get caught up in the ups and downs of the trading value of your investment and sell when its value goes down temporarily, even though the performance of the company is still stellar. Remember, you're in it for the long haul. Some people prefer to see how they're doing once a year. That's probably not often enough. What's best for you will most likely to be somewhere in between based on your goals and investments. But it's not enough to simply check an investment's performance. You should compare their performance against an index of similar investments over the same period of time to see if you're getting the proper returns for the amount of risk that you're assuming. You should also compare the fees and commissions that you're paying to what other investment professionals charge. While you should monitor performance regularly, you should pay close attention to every time you send money somewhere else to work. Let me repeat that. You should pay close attention every time you send your money somewhere else to work. Every time you buy or sell an investment, you will receive a confirmation slip from your broker. It could be an email, it could be a regular mail. Make sure that each trade was completed according to your instructions. Make sure the buying or selling price was what your broker quoted. And make sure the commissions or fees are what your broker said they should be. So you want to watch out for anything unauthorized. So if you have unauthorized trades in your account, you want to basically contact the broker and ask for information. If you get a confirmation slip for a transaction that you did not approve beforehand, contact your broker. It may have been a mistake. If your broker refuses to correct it, put your complaint in writing and send it to the firm's compliance officer. All brokerage institutions have a compliance department, and you want to contact them if you have a complaint or a serious complaint. Now, serious complaints should always be made in writing. Never, not on the phone or no. It has to be in writing. Remember too that if you rely on your investment professional for advice, he or she has an obligation to recommend investments that match your investment goals and tolerance for risk. One thing that's very important, and I want to mention it here, your investment professional should never be recommending trades simply to generate commissions. It is illegal and it's called churning. So if you meet a brokerage agent or a financial planner or financial advisor who is just telling you to buy stocks because his or her firm is generating commissions through those purchases, that's churning, and this is punishable by law. This is not acceptable. Another way to protect yourself is to learn how to avoid problems. Choosing someone to help you with your investment is one of the most important investment decisions you'll ever make. While most investment professionals are honest and hardworking, we live in a world and nobody's perfect. You must watch out for those few unscrupulous individuals. They can make your life savings disappear in an instant, and we've seen that. So securities regulators and law enforcement officials can and do catch these criminals. But putting them in jail doesn't always get your money back. Too often the money is gone. The good news is you can avoid potential problems by by protecting yourself. I told you earlier, you speak to your investment professional, you monitor your own investments. You want to make sure the investment professional and his or her firm are licensed and registered. And how do you do that? There is a free database called investor.org, www.investor.gov. And this is a website that was built by the United States government that helps investors. You can find additional information by visiting the website of the North American Securities Administrator Association, NASA, or you can go to nasa.org, or you can call 202-737-0900. The number again is 202-737-0900. And we'll just put it on the screen right now. Important contact that you need to remember today. Please take a screenshot of this and keep it in your phone if you're watching this from your phone. So important contacts. You have the SEC. You have the SEC is located as at 100 F Street, Northeast, Washington D.C. 2549-0213. The toll-free number to contact the SEC investors complaints line is 800-732-0330, and the website for this is investor.gov, and NASA is 750 First Street Northeast Suite 1140, Washington DC 20002. The phone is, as I said earlier, is 202-737-0900. You should also find out as much as you can about any investment that your investment professional recommends. First, make sure the investments are registered. Keep in mind, however, the mere fact that a company has registered and files reports with the SEC does not guarantee that the company will be a good investment. So you want to be wary of promises of quick profits, offers to share inside information, and pressure to invest before you have an opportunity to investigate. These are all warning signs of fraud. Ask your investment professional for written materials and prospectuses and read them before you invest. So if you have questions, now is the time to ask. For example, how will the investment make money? How is this investment consistent with my investment goals? What must happen for the investment to increase in value? What are the risks? Where can I get more information? So those are important questions that you need to ask that can help you make the right decision and protect yourself in the process. Let me give you a few final tips here. It's always a good idea to write down everything your investment professional tells you. Accurate notes will come in handy if there's ever a problem. Some investments make money, others lose money. That's just how things work. It's natural, and that's why you need a diversified portfolio to minimize your risk. But if you lose money because you've been cheated, that's not natural. There is a problem. So you want to call or write to the SEC and let the agency know about the problem. Investor complaints are very important to the SEC. SEC again here is the Securities and Exchange Commission. You may think that you're the only one experiencing a problem, but typically you're not alone. Sometimes it takes only one investor's complaint to trigger an investigation that exposes an illegal scheme. Complaints can be filed online with the agency by going to www.sec.gov/complaints.html. Again, the link is www.sec.gov/complaints.html. All right. This is it for today's conversation. It was a longer conversation, but this is an important topic. We were talking about saving and investing for students, and I'll just quickly go through the recap of today's conversation here. So step one, make a financial plan. Know the things you want to save and invest for. Know your current financial situation. Know your income and expenses. Pay yourself first. Find money to save or invest. Step two, remember that all small savings add up to big money. Pay off credit card or other high interest debt. Learn how to make your money grow. Know the two ways to make money. Your money can work for you in two ways. The differences between saving and investing. Why some investments make money and others don't. Mutual funds and exchange traded funds, ETFs. Mutual funds and ETFs without active management. You want to watch the turnover to avoid paying excess taxes. You want to learn to protect yourself, ask questions, monitor your investments, learn how to avoid problems. I wish you good luck in your financial journey. I will see you next time. But until then, remember, stay marvelous.